they need to get those things introduced back to their portfolio quickly, lest they find themselves in that underperformance seat. All right, everybody. Good afternoon. Stephen Weitzel, Chad Smith from Reveille Wealth Management, just coming to you, sharing some insights of a conversation that we have as we're leading the investment committee here at Reveille, talking about where we see the markets headed into 2026. Just want to give you a little peek inside the conversations that we have and how we see the investment landscape changing as we move into next year. And one of the main things that we've been talking about for a while has been the need to continue to lean into diversification, that the areas of a globally diversified portfolio that underperformed for so long, some areas have really started to provide some accretive support this year in the international space. We're going to come back and have a completely separate video talking about the merits of continuing to have exposure to the international markets. But Chad, today our conversation is about the small cap U.S. markets that have underperformed their large cap counterparts by just a significant amount over the last 10, 12, 15 years, to the point now that people are so underallocated to them, and they've been expecting, or the industry's kind of been expecting, some rotation into the smaller cap names for a little while. But we want to delve into maybe what the opportunity set looks like, what some of those catalysts are, and how we think people need to be positioning themselves as we go into next year.
Yeah, absolutely. Well, and it's an important point, what you said, of course, about diversification, because what we've seen is that as large cap U.S. stocks have been dominating for quite a while now, that of course leads to investor infatuation with that which has done the best, right? Recency bias.
Yeah.
And so that's further reinforced by this incredibly kind of progressive, ongoing acceleration, so to speak, in passive investing. And with all the different indices around the world, and especially in the U.S., being market capitalization weighted in how they're constructed, and we've talked about this, of course, numerous times in many different white papers and videos we've put out. But it's kind of just raising the awareness of the degree to which the indices in the U.S. are dominated by a handful of, a small number of the largest companies, and the overconcentration that has resulted in, and how that is just continuing to escalate because of the passive investing craze. People are just pouring money into indexes or indices in the U.S. equity market, or even, like, for example, target date funds in their 401k plans that are highly comprised of large cap U.S. indices and the representation of those. And so the result has been an ongoing kind of building up or percolating of these extremes in the market. The relative valuation of large cap U.S. stocks versus everything else, the relative concentration of exposure to large cap U.S. growth stocks to everything else, and how that trend has been strong and we need to respect it. But yet the extremes have built to the point where it seems as though the time has drawn nigh for there to be a shift, a pivot, a rotation. And so on the one hand, it raises kind of the risk awareness that we need to have about the market overall, but also leads us to look at opportunities, right, of where the rotation could result into other things that benefit from this changing of the guard and cycle changes. And specifically, we've been highlighting the opportunities we see in small caps. And now we're beginning to finally see that come to fruition a little bit in the last few months, right?
Yeah, and to your point, the concentration in the markets has been a double-edged sword. That if somebody has really chosen to, I'll say, ignore the level of risks in the market, they could have ridden it maybe a pretty good ways. But it can cut both ways. And when you have that much market concentration built up, that sooner rather than later, when those names start to falter, if that's where most of your assets are allocated, even unwittingly so. I think
Hmm.
15% of the S&P right now is comprised by the two largest stocks out there, Nvidia and Microsoft. I just heard our friend Larry McDonald share that with Maria Bartiromo, and that's maybe 3 to 4 times what he's seen in terms of what the largest two stocks would comprise in the S&P 500 over the course of his tenured, illustrious career. So we're in
Hmm.
some rare air here. And,
Yeah.
when we look at analysis from our friends out at Research Affiliates, so this is Rob Arnott's group. They're based out in Newport, California, close to our friends at PIMCO. And they're giving guidance to the largest pension funds and institutional endowments in the world about where they need to be allocating their assets. And so they look at a bunch of different asset classes. I mean, from publicly traded equities to fixed income to currencies and commodities and alternatives and all
Yeah.
sorts of things. And they've got all of this historical data over risk and return. And they use that to try to gain some perspective about where is this thing going, right? Based on historically how it's done and how it's done in the more recent past, 1 year, 3 year, 5 year, 10 year, what's it likely to do in the next 1 year, 3 year, 5 year, 10 year period?
Right.
And so their expectation, today, here we're at the end of 2025, looking into 2026, their expectation for where they see these things going um, is not good. Or I would
Hmm.
say for large cap U.S. equities, it is not strong. They are only expecting about 0.5% of annualized return out of large cap U.S. stocks over the next decade. Now,
Right.
this is real rates of return, so adjusted for inflation. Whereas small cap U.S. stocks, they're expecting them to return just shy of 5% annually over the next decade, which much stronger, obviously a little more risk incumbent in investing in the small cap stocks versus the large cap stocks, but probably one of the largest spreads that we've seen historically.
Hmm. Yeah. And what's interesting is, that's a couple of things come to mind when we look at that data. One of the primary inputs to this um, projection that they make, or forecast that they make, is the starting point of valuations prevailing across all the different asset classes, right? So because of where we are in the level of valuation, in this case, price to earnings ratios of large cap US stocks, when you compare that to historically all the data points that exist, the correlation is that at this level of valuation, historically, the projected or the subsequent returns in the next 10 years annualized has been very muted. And so one, investors need to temper their expectations for returns in general versus what they've experienced. That's number one. Number two, if this is going to play out the way they projected, you need to look elsewhere besides just where everybody is now. And that brings up the point that, of this concentration. And so if small caps domestically are the most attractive in terms of projected returns, it's interesting that as we look at this data, Stephen, that right now, small caps as a percentage of all the domestic equity assets in the market is at an all-time low. The percentage that small caps represent of at least within exchange traded funds domestically is down near 6%, all-time low.
Yeah, well, and I think that would be a pretty good representation. That's the way that a lot of institutions are putting money to work. Because so many things have gone the passive investment route, and people are using ETFs to really represent their market exposures. That gives you an idea of how much people are underrepresenting small caps in their portfolios
Right.
if they only have 6% of ETF assets allocated into the small cap space. I imagine that the allocation to the large cap space is many, many, many times larger than that. Um,
Absolutely.
but so, all right, so we've got the starting valuations as a big headwind for the large cap space. Uh, that starting valuations for the small cap space are where they have to be below average at this point.
Yeah, yeah. Well, so looking at some data just from a couple months ago, the Russell 2000 was trading at around 15.4 times forward earnings, which is below its 10-year average of 16 and a half times earnings, so below its own average. But when you look at it versus the Russell 1000 index, the largest stocks in the market, that spread between the two, the Russell 2000 and the Russell 1000, is the widest it's been since the tech bubble in 2000. So
Wow.
25 years ago. And so
Well,
just
and I think that
go
that
ahead.
that would be really consistent, right, with what we see when we compare the Russell to the S&P 500, right?
Yep.
Obviously, the S&P 500 is going to be a little more concentrated than the Russell 1000, even though they're both market cap weighted indices, and their
Sure.
largest holdings are going to be pretty much congruent. But we see that the relationship between the Russell 2000 and the S&P 500, it is actually worth less today on a relative basis, the Russell 2000, than it was back at the peak of the dot-com bubble in March, April of 2000.
Right.
But as the tech bubble was bursting, that was the onset of about a 11-year run or 11-year period of outperformance for small cap US stocks. And we're starting to see that, even though we haven't taken out those former lows yet, and we really like to see that,
Yep.
this has, according to our own investment process here, this actually has turned a corner and is back in an uptrend that would favor the small caps when we're just looking at it on an intermarket perspective. But let's talk about a couple of what we think the fundamental drivers could be. What do we see that could come down the pipe here that would be more beneficial for the small cap companies relative to their large cap counterparts?
Yeah, certainly. Yeah, so we need, like you mentioned, we see these extremes that this chart exhibits, and you think, wow, that's very attractive, right? We're down here in the pocket and ready to see this extreme start to, kind of correct itself. But to your point, we need a catalyst to get it going. It's beginning to turn. That's great. But if it could turn the corner, we could see something significant. So, a couple things are prevalent today that could very well serve as catalysts. One is tax relief, right? Under the big beautiful bill, there are a lot of components to it that really could favor small cap companies. And you see on the margin that could incrementally benefit small cap companies more. Another one is deregulation, which is another part of some of the things that the Trump administration has passed. So more deregulation results in less or lower costs of compliance with governmental regulations on the margin that incrementally benefits small cap companies. Another
Yeah,
one
I think an example of that one too that they floated, and I don't know if they're going to pass this or not. Remember, they talked about potentially going to the semi-annual earnings releases
hmm
instead of the quarterly. Like if the company's publicly traded, that right now everybody's having to file quarterly reports,
yeah,
and
very cumbersome
and
and
it's
expensive.
expensive, right? I mean, they're paying a lot of money to these auditors, and the auditors and the attorneys are the ones that are making a lot of the money. And so, if for the small cap companies, if they're only going to have to do that twice a year instead of four times a year, again, that's money that they're getting to keep in their pocket. They can invest in their business operations. Um, and
Yep.
so, yeah, that's just another example. What else?
Well, so yeah, so a couple others are one is interest rates, right? The interest rate environment has shifted. The Fed's begun a cycle of, or has been in a cycle of lowering the Fed funds rate. Historically, rate cuts have tended to give more of a boost to small cap stocks on the margin incrementally. A lot of that's a function of leverage. Small companies tend to have a bit more leverage than large companies. So, again, that can be incrementally more beneficial as we see rates come down. And then the last one that comes to mind is what you and I have been talking about a little bit is this bubble that we're in, or this massive boom that we're in the AI build out, AI infrastructure. Obviously, AI is here to stay, and it's having an incredible impact on our society. It's probably the fourth industrial revolution of the world, or whatever number we're in now. But what we've talked about recently and highlighted is the thing about it is now we're at this level of just gargantuan investment in the infrastructure for AI. Most of these bigger companies are having to incur that, or outlaying, or they're announcing, at least not fully happening as of yet, but announcing these massive investments, hundreds of billions, upwards of trillions of dollars in infrastructure build out for AI. But yet, meanwhile, you got all these companies out there, like small cap, especially in the small cap space, that are going to be able to take advantage of the innovation of AI and leverage it in their business for improved productivity and cost cutting, and it's going to incrementally benefit them even more so, maybe without the massive investments that are being made by the bigger companies.
Yeah, and that was one of the topics that we covered in one of our more recent podcast topics. Was that, in a very similar vein to what happened back during the internet build out, the internet revolution,
Hmm.
was that technology at one point in time was very expensive,
Yep.
and it was the largest companies at one time that were able to actually afford that investment in the technology, whether it was the computers, the processors, the the wiring and
Switches
everything
and
that
all
had the
that. Yep.
switches, all that kind of stuff, to be able to introduce it into their business and get some of those productivity gains. But it was prohibitively expensive for the smaller companies. But
Hmm.
the technology is going to become more obsolete over time, or just the speed of the technology is going to promote that what is available today is going to effectively be useless or obsolete in the market
Hmm.
within a couple of years. It's going to be much more cost effective. And so these smaller companies that they can't afford to implement AI right now because it costs too much, but a couple years from now, when they're able to buy these, what would amount to be a cutting edge AI system today in 2025, when they can do that for, maybe 10% of the cost
Hmm.
in 2027, and all of a sudden they can use that, and it's going to improve their efficiency and their productivity and make them more profitable, then it's going to have a much bigger impact on their bottom line. And that, interestingly enough, may be a very similar type of environment that we saw post the dot com bubble, when that technology, when the price of the internet and computers, it was falling, substantially.
Yep.
Um,
Yep.
but that was a period where these companies were going to be able to invest in that, realize the benefits from it. And that was when we had our last cycle of secular outperformance out of the small cap space. And that may be on deck for us,
Yep.
hopefully in 2026. Um, we have again turned a little corner here. Really want to see us take out these former lows right here. This ratio has not been oversold here for quite a while, so I think that's very constructive. It's going to be interesting to see how the market continues to move here. But look, we're going to continue to have these discussions. We're going to come back where we're going to talk about the case for continued exposure to international markets. We're going to be talking about things like whether investors should continue to be exposed to commodities, and that ultimately the diversifiers in the portfolio that have been laggards for so long and that so many people have just chosen to forsake them, that they need to get those things introduced back to their portfolio quickly, lest they find themselves in that underperformance seat. So,
Yep,
anything
absolutely.
else before we wrap up today?
Nope, that's good. I think we just want to be, aware of the environment that may be shifting, the opportunities that it presents, and watch carefully as these trends unfold. And just, we would always advocate following a discipline. We also like our discipline and approach it from that angle.
All right, buddy. Well, I appreciate the time. Thanks, everybody, for tuning in. We will see you shortly on our next episode where we're going to continue to review this rotation into these other diversifiers in your portfolio. Continue to check back for that. If you have not already, make sure that you have subscribed to our YouTube channel, to our social media channels, so you're getting all of these updates as soon as they're available. As always, if you have any questions for us, feel free to shoot us an email to info@reveillewealth.com. Take care, everybody, and we will see you next time.